All right, let's talk about that feeling many of us have right now. The ground beneath our feet feels a little, well, shaky. Whether you're an investor mapping out your next move, running a business, or just, trying to keep your household budget steady, there's this palpable uncertainty. What felt rock solid maybe a year or two ago suddenly seems at risk. It's that constant sensation of things shifting, leaving many of us feeling, well, skittish.
It's striking how universal that feeling has become. Yeah, we see it across the board, from businesses rethinking capital investments to households, holding off on big purchases, even central banks grappling with policy. Uncertainty really is a defining word for 2025, isn't it?
Absolutely. And that's exactly why we're diving deep today. Our mission with this deep dive is to cut through all that noise, right? To give you a shortcut to understanding what's truly important. It's designed to help you unlock opportunity even when everything around you feels so, well, uncertain. We're going to unpack JP Morgan's 2025 Mid-Year Outlook, which they've aptly titled Comfortably Uncomfortable.
And that title alone, it speaks volumes, doesn't it? This report specifically addresses 5 essential questions, all aimed at helping investors navigate this environment and, make progress toward their financial goals. Zooming out a bit to the report's forward, it suggests the global economy is expected to lose some steam in the short run. Increased recession risks there. However, the long-term outlook anticipates weathering these headwinds thanks to growth-friendly policies eventually taking effect.
Right. And the report strongly highlights that the evolution of U.S. policy is going to play a major role in shaping markets worldwide.
Hmm.
So our mission ahead is clear. We're going to tackle these 5 questions head on with the ultimate goal of helping you build a resilient, thoughtfully designed portfolio, one that can not only align with your long-term goals, but also withstand these periods of heightened volatility. So let's jump right in with the first big question. Should investors cheer or fear Trump 2.0?
That's a critical question, yeah. Especially because markets initially did cheer the incoming U.S. administration, largely expecting, pro-growth and investor-friendly policies. What's striking is that the reality of Trump 2.0 has meant less market-friendly policies, particularly tariffs, have arrived much more quickly than many anticipated.
Yes, that immediate sequencing of policies, it really caught the market off guard. The report details how measures like higher tariffs, less immigration, and even austerity through government spending cuts from the Department of Government Efficiency, or DOGE,
OGE, right.
are taking effect rapidly. This has led to a significant spike in U.S. policy uncertainty and a noticeable collapse in business and household confidence.
Precisely. And on the tariff impact, JP Morgan's report highlights that these new tariffs signal an abrupt and chaotic reversal of the post-World War II free trade trend. The direct impacts are pretty clear. Higher tariffs lead to slower growth, higher prices, and ultimately lower corporate profits.
And the severity of this is significant, right? The U.S. effective tariff rate is estimated to settle in the mid-teens, which the report points out is the highest level since the Smoot-Hawley era of the early 1930s.
Yeah.
To put that in perspective for you, these proposed 2025 tariffs are nearly 4 times larger than the 2018 duties when measured as a share of GDP.
4 times.
In fact, the report states they represent one of the largest non-wartime tax hikes in U.S. history.
That's huge. And this isn't just a U.S. issue. The global nature of this trade war increases downside risks and, shifts trade war vulnerability. For instance, this has contributed to non-U.S. assets outperforming U.S. assets so far this year.
It's a powerful shift. And speaking of non-U.S. outperformance, Europe's economic outlook is actually brightening as investors begin to focus on these U.S. growth headwinds. We're seeing specific actions like Germany boosting defense spending and regional industrial policy, creating secular investment opportunities in areas like electrification and reshoring manufacturing.
Right, bringing it back home.
Yeah, and the report suggests this could boost annual Eurozone growth from a rather modest, 0.5% pace in 2025 to over 1% in 2026.
Okay, so a noticeable pickup. Looking a bit deeper at domestic policy here in the U.S., the actions taken by the Department of Government Efficiency, DOGE, have resulted in over 275,000 announced layoffs. And another significant drag on jobs growth and spending is an 80% decline in net immigration from the 2023 peaks.
Wow, 80%.
Yeah.
Plus, we have serious tax bill concerns on the horizon. Congress is contemplating a tax bill that could add nearly $6 trillion to the budget deficit over the next 10 years.
Scary.
The report stresses this is larger than the 2017 Tax Cuts and Jobs Act, the CARES Act, the American Rescue Plan, and the Infrastructure Investment and Jobs Act combined. That's a massive potential increase in the deficit.
It really is. And this leads to an interesting point for, fixed income investors who are assessing the compensation needed to finance this proposed borrowing binge, especially with longer term bond yields already near cycle highs. However, there is a potential silver lining here with deregulation. So large U.S. banks have built up more than $200 billion of excess capital over their current requirements. Now that capital rules are likely to be softened, this excess capital is likely to be deployed.
Ah, okay. So the report is essentially saying there's a significant amount of dry powder in the banking sector that could be unleashed. That completely changes the dynamic, especially for bank stocks, right?
Exactly. That capital could go into private sector loan growth, which is a priority for the U.S. Treasury Secretary, or share buybacks.
Like Goldman Sachs.
Yeah, like Goldman Sachs's announced share repurchase plan worth, 26% of its market cap? Huge. And we could see more banking sector consolidation, like Capital One's purchase of Discover. So yeah, bank stocks may be among the high-profile beneficiaries in the second half of 2025 if the administration starts to focus on the pro-growth aspects of its agenda.
And this talk of capital deployment naturally brings us to tech stocks. After a tough start to the year, they've been underperforming, haven't they?
They have. The technology sector down over 8%, and Magnificent Seven stocks, those are the largest, most influential tech companies like Apple, Amazon, Microsoft. They're down over 12% year to date.
But the report suggests tech stocks could get a second wind. Why is that?
Well, a couple of reasons. Company earnings are strong. The Mag 7 is expected to deliver 15% EPS growth in 2025 versus about 8% for the rest of the market. So strong fundamentals there. And on the valuation front, while the Mag 7 stocks don't look cheap on an absolute basis, their valuations relative to the rest of the market are actually at their lowest levels the last 10 years.
Oh, interesting. Relative value.
Exactly. And another positive signal is the administration's decision to exempt, for now anyway, semiconductors and other electronic products from tariffs, which is viewed positively.
Okay. So what does this all mean for the overall market outlook? What's the bottom line here?
Well, the report concludes that while tariff policy and the uncertainty it generates will likely pressure economic growth and corporate profits for, the better part of the coming year, it may not stop a bull market. The administration's more investor-friendly proposals, things like potentially lower interest rates, lower energy prices, less regulation, they may well materialize in the second half of 2025.
And the big takeaway for you, the listener, is that key developed market equity markets, including the United States, Europe, and Japan, should make new highs by the middle of next year. Investors just need to get comfortable with uncertainty and volatility, I guess. Choppy markets may last for a while. It sounds like equity markets love to climb that proverbial wall of worry.
That's the classic phrase, yeah.
So we're navigating this wall of worry. But that brings us to our second essential question. Is your portfolio resilient enough for these growing risks? The report emphasizes that investors face a clear regime shift.
That's right. The post-global financial crisis era, let's say roughly 2009-2020, saw portfolios gravitate to assets that performed well in that environment of low inflation, low rates, and pretty modest volatility, mostly U.S. equities, right?
Right.
Today, investors face two-way risks to growth and inflation, and what looks to be persistent policy uncertainty. It's a significant regime shift, and it has important implications for building resilient portfolios.
So defining resilience in this new regime is key. How does the report describe that?
It describes a resilient portfolio as one that includes assets with low or ideally negative correlations to each other, and each asset having an intrinsic ability to outperform cash. Collectively, these assets offer the potential to mitigate the severity of portfolio-level drawdowns. And of course, core fixed income remains the primary source of portfolio resilience in a growth downturn. That hasn't changed.
Okay. And looking at the broader implications, one of the growing risks you mentioned is inflationary pressure.
Yeah, the report notes that a weakening dollar and a growing fiscal deficit could push U.S. inflation higher. Their analysis suggests a total impact on core PCE inflation.
The Fed's favorite measure.
Exactly. Personal consumption expenditures minus food and energy. The report estimates it could see a 1.43% annualized increase just from the fiscal deficit expansion and the USD depreciation combined.
So against that backdrop, the report highlights 4 attractive asset choices that could help make portfolios more resilient against these sort of countervailing risks. What's the first one?
First up are equity-linked structured notes. Their appeal right now is due to elevated implied equity market volatility and higher interest rates. This offers potential for greater downside protection or maybe higher coupons. And get this, Client utilization of structured notes has apparently doubled this year relative to 2024.
Doubled. Wow. Okay. And they offer income not tied to fixed income, right?
Exactly. Diversifies your income streams.
Okay. What's next?
What's striking here is the next choice. Hedge funds. For suitable investors, of course, they can potentially strengthen portfolio resilience. From December 2019 to August 2024, the report found almost 80% of randomly generated hedge fund composites actually outperformed a simple stock bond mix on a risk-adjusted basis.
80%. That's pretty compelling.
It is. Looking ahead, they expect diversified hedge fund strategies to deliver returns and volatility that are slightly higher than core fixed income, but crucially with very little correlation to it. Especially less correlated strategies like relative value and macro, they also emphasize potentially strong after-tax returns.
That sounds like a powerful diversification tool. Okay, number 3.
Third choice is infrastructure.
Ugh.
The focus here is on long-term contracts that often embed inflation protection. Very important now. Furthermore, over 40% of the historical returns of infrastructure investments are driven by income, steady income.
Makes sense.
And with a secular shift toward greater demand for power generation, digital infrastructure, plus, more frequent and severe climate shocks reinforcing the need for resilient infrastructure. It's a compelling area. Since the second quarter of 2008, infrastructure has generated total returns in the low double digits on an annual basis, according to the report.
Solid long-term play. Okay, and the last one, gold versus crypto.
Yeah, an interesting comparison. The report positions gold as offering protection against further geopolitical risk and potential dollar weakness. Many central banks like Saudi Arabia, Taiwan, Japan, China, Singapore, Brazil, Korea still hold less than 7% of their foreign reserves in gold.
Really? Only 7%?
Yeah, compare that to Germany and the United States, each holding over 75% of their reserves in gold, so potentially more buying from other central banks.
Okay, and crypto.
The interesting contrast is with Bitcoin and other crypto assets. Despite their low correlations to traditional assets, which sounds good for diversification, crypto assets have historically made portfolios more fragile. Why? Much higher volatility. They mention that a 5% addition of cryptocurrency to a balanced portfolio can result in a significantly higher risk contribution than a 5% addition to gold.
So potentially more risk than reward for resilience.
Yeah.
Got it. So what does this all mean for portfolio hygiene, keeping things tidy?
Right. The report underscores the importance of addressing portfolio drift. They give a great example. A standard 60% equity, 40% fixed income portfolio from back in 2020 will likely have drifted to something closer to 75%, 25% today, simply due to the massive outperformance of equities.
That's a huge shift without even making a trade.
Exactly. It also highlights the risk of overconcentration in U.S. dollar assets because of that recent outperformance. So a truly resilient portfolio needs to address market drift in a timely fashion. Rebalancing is key.
That brings us neatly to our third essential question, which is sparking a lot of spirited debate right now. Is this the downfall of the U.S. dollar? The report dives into this, leaning towards maybe a significant but not existential change.
That's the gist, yeah. The report lays out clearly why the dollar has held its primacy for so long. The U.S. commands the largest and most stable economy in the world, along with the deepest and most liquid financial markets. Plus, a well-established rule of law, strong institutions, a culture of innovation, all supported by its military backbone. These are powerful, long-term factors.
Yet the dollar is facing current risks. So far this year, it's lost value relative to every other major currency.
Yep.
Tariff rollouts, trade policy uncertainty, that's part of the story, right?
Definitely. But investors are also increasingly concerned about the U.S. fiscal outline, especially amid potential congressional legislation that could substantially increase that budget deficit we talked about.
That $6 trillion figure again.
Exactly. Putting this in context, though, the report believes those risks will manifest in a more subtle erosion of the dollar's value, and not a sudden collapse. Today, the dollar accounts for 60% of foreign exchange reserves, 65% of international debt, and nearly 85% of SWIFT trade finance settlements.
85%? Wow.
Yeah. Network effects are powerful. Moving to a new primary medium for international trade and financing just wouldn't happen quickly. The second most used currency, the euro, account for just 6% of SWIFT settlements. It really shows the scale of the dollar's dominance.
Okay, so while the decline is real, a rapid unraveling isn't the base case. What about investor sentiment? What are people thinking?
Well, nearly 70% of investors surveyed think the dollar is overvalued, and a net 61%, which is the highest share since 2006, expect it to continue to depreciate. So the expectation is definitely for more weakness. The report's base case is that the dollar loses maybe a few more percentage points by the end of the year against major currencies, with risks tilted to the downside.
And does history offer any clues here?
It does. This connects to important historical context. Previous periods of sustained dollar weakness like 1970, 1980, 1985, 1992, and 2002, 2008 resulted in roughly 40% depreciation over a 5 to 10-year period.
40%.
Yeah, but gradual, right, over 5 to 10 years. This suggests a pattern of gradual shifts, not a sudden cliff edge.
Okay, so what does this mean for currency diversification for investors?
The report explains that diversifying currency exposure can mitigate potential losses associated with dollar depreciation. They are focused on the euro, the Japanese yen, and gold due to their size, liquidity, and historical roles as alternative reserve assets. And central banks, sitting on nearly $13 trillion in reserves, have already started increasing allocations to these currencies.
What's particularly interesting is the opportunity for U.S. investors specifically. What's the path there?
Well, the path of least resistance for U.S.-based investors could be exposure to equities denominated in the euro and yen. In fact, JPMorgan Asset Management's own 2025 long-term capital market assumptions suggest that U.S. dollar depreciation will add 1% to 2% annually to total returns for European and Japanese equity investments when measured in U.S. dollar terms for the next 10 to 15 years.
There's an extra 1–2% a year just from currency.
Potentially, yes. And importantly, those equity markets are also expected to outperform the United States on an absolute basis, according to their forecasts. Investing in private equity could also be a way to diversify geographic and currency exposure.
Okay. Now, finally, they introduce a unique market credibility metric. What's that about?
Yeah, it's interesting. It tracks the percentage of trading days in which stocks, bonds, and the U.S. dollar all lose value simultaneously, kind of a nowhere to hide day. In the U.S., this happens in around 7.5% of trading days over the last 3 years, but only 5% so far in 2025. This suggests that maybe the noise surrounding the dollar has been greater than the observed market stress so far this year.
How does that compare elsewhere?
Well, compare that to Brazil, where the share is upward of 20% of trading days, or the UK, which they describe as the most troubled developed market on this metric.
Right. So the conclusion here seems clear. The U.S. dollar's status as the world reserve currency won't suddenly vanish, but there is an elevated risk of an era of dollar decline, and investors still have time to mitigate the impacts on their portfolios.
Precisely. It's about managing the risk, not panicking.
Okay. From the dollar, we shift to a question that seems almost rhetorical, but it's crucial. Why isn't anyone talking about AI anymore? The report suggests that, well, tariff policy uncertainty has just overshadowed this incredibly important secular trend.
That's exactly right. It's like the market has short-term memory sometimes. What's striking here is looking back at the March sell-off. AI-linked stocks really hit a wall, as the report puts it. They found 20 companies, nearly two-thirds of them exposed to AI, accounted for a whopping 80% of the S&P 500's peak-to-trough losses before April 2nd.
80% from just 20 stocks. Wow. And the trigger for that AI stock sell-off was pretty specific, wasn't it?
It was. It was a Chinese startup called DeepSeek launching a new AI model that challenged many of investors' prevailing assumptions about the resources needed to develop high-performing AI. It demonstrated lower costs and stronger performance, making investors question whether the hyperscalers or, the big cloud computing players like Amazon and Meta might be getting too aggressive with their capital expenditure plans.
But despite those concerns, are the hyperscalers pulling back?
Not really. They seem to be full steam ahead. Wall Street analysts are now penciling in nearly 33% capital expenditure growth from the 4 major hyperscalers over 2025. That's a significant jump from estimates of just over 20% capex growth at the start of the year.
Okay, so the spending continues.
Oh.
What does the report say about the potential of AI itself?
Well, what the report highlights next regarding AI is quite remarkable. It will catalyze substantial productivity gains for businesses, consumers, and the economy as a whole. That conviction is strong. They give some striking details. Large language models can now deliver PhD-level outputs, while their costs have plummeted by between 80% and 99%.
99% cheaper. That's incredible.
It really is. That's a dramatic shift, and it reminds me of historical breakthroughs like, say, the Bessemer process for mass-producing steel, or even the rise of air travel and personal computers. These things only enabled widespread adoption after dramatic cost declines.
So where are we in the AI race right now?
Well, it's an interesting juncture. Leading research labs are still incentivized to raise funds and invest in new models as they compete to develop a model that can maybe even improve itself. At the same time, competition could drive prices lower, which encourages differentiation and further adoption across the board.
And the next wave, what are they looking at?
The report expects agentic AI. These are programs that can operate with a human-like level of intelligence and independence, will likely dominate the next wave of software. The idea is they'll deliver both a better consumer experience and significant productivity gains for enterprises across sectors and geographies.
And it's not just a U.S. phenomenon either, right?
Not at all. The tech sectors in Europe and China were actually closing the performance gap with US-based tech companies after the release of ChatGPT back in November 2022 and before this recent tariff shock hit markets. So the capability is globalizing.
Looking at the broader implications, how important is private market exposure here?
Crucial, according to the report. Out of nearly 100,000 investable software companies globally, only about 4,000 are public.
Only 4,000 public out of 100,000.
Yeah. And get this, 87% of U.S. companies exceeding $100 million in annual revenue are private. The total addressable market for AI-related applications could surpass both the cloud and mobile transitions, largely because the ultimate target is, well, employee compensation costs. That's a huge target.
But is it a bubble? We hear the dot-com comparisons all the time.
The report says not yet. They argue that neither the levels of AI capital expenditure nor current stock valuations suggest an AI bubble in the market right now. Stock prices have largely risen in line with earnings, you see. And the capital expenditure hasn't been financed by excessive equity or debt issuance, which was a hallmark of the dot-com era. However, they are closely monitoring payback periods on these AI projects and looking for pockets of froth, especially in sectors like data centers.
So, watchful waiting. But is AI actually delivering results yet?
Yes. The most recent earnings data suggests that AI is starting to deliver for companies and investors. They point to Microsoft's cloud computing unit reporting 35% growth, with AI demand contributing nearly half of that.
Nearly half from AI already.
Apparently so. And the company processed over 100 trillion AI tokens in the first quarter, which is a 5-fold increase from last year. The usage is exploding.
Okay, so the report concludes by outlining areas of focus.
Yeah, basically. Companies and sectors poised to benefit from cost savings and productivity gains from AI, I think software, financials, and also promising names emerging in that agentic application space. The message is clear. People may not be talking about AI as much right now, but they should be. It's a huge ongoing structural trend.
Absolutely. Okay, moving on to our final essential question. What's the deal with deal making? Most of Wall Street initially expected an immediate revival in deal-making and capital market activity right after the election. The capital market subsector even rallied 10%, didn't it? Doubling the broad market for a bit there.
It did, but what's striking here is how quickly those hopes met the reality of, well, tariff-driven uncertainty, still elevated interest rates, and choppy equity markets. While private market deal-making continues at a, let's say, reasonable pace, the public market arena, notably IPOs, has been very quiet. Eerily quiet almost.
Yeah, expectations for completed U.S. M&A activity have been revised down sharply from, 25% growth originally expected, down to just 7% now.
That's right. And while global M&A did rise 17% year over year in the first quarter, driven mostly by sponsor-backed activity, the prospect of prolonged uncertainty has definitely created a cloudier outlook on the pace for deal-making, at least over the near term.
And what about the regulatory side, the FTC's role?
Yeah, that's important. Under new leadership with Andrew Ferguson, the Biden-era merger guidelines actually remain in place, which disappointed some market participants. On the other hand, Ferguson's FTC seems to focus its rule enforcement based on consumer welfare, which is generally seen as a more market-friendly approach than his predecessor. But on the specific contentious subject of big tech, the Trump FTC seems likely to maintain an adversarial stance, so maybe not much change there.
Okay, putting this in context, how is the private equity ecosystem itself doing? Is it finding balance?
It seems to be coming into better balance, actually. After 2 years, 2022 and 2023, where capital calls exceeded distributions, which meant negative cash flow for investors, LP's 2024 saw capital calls roughly in line with distributions. That's a significant stabilization.
So this slower pace of traditional deal-making, plus aging assets in existing PE portfolios, does that create opportunities?
It could, yeah. The report argues it creates a potentially compelling opportunity set for secondary managers. These are the managers that buy existing private equity stakes from other sponsors or investors. Historically, secondaries have been attractive for several reasons. They tend to mitigate the J-curve effect, that initial dip in returns you often see. They offer visibility into the underlying assets, reducing blind pool risk, and they provide meaningful diversification across vintage year and manager.
And potential catalysts like college endowments needing liquidity could fuel this too.
Exactly. That's cited as another potential catalyst for secondary market activity.
And the report highlights another significant trend, the rise of evergreen funds.
Yes, these structures are likely to alter the private market landscape pretty significantly over time. They currently represent about 5% of the overall private markets, but some estimate the share could grow to 20% in the next decade.
20%, that's a big shift.
Huge. And in 2025 alone, the report notes over 4,500 clients have invested in evergreen structures for the very first time. They offer asset owners more potential opportunities for liquidity beyond just the traditional routes of IPOs and strategic M&A.
This leads to a key insight for public market investors too, right? Companies staying private longer.
Absolutely. Today, the median company that goes public is almost 14 years old. 10 years ago, the median age of an IPO was less than 11 years old. And as we mentioned earlier when talking about AI, of all the companies that exceed $100 million in annual revenue in the United States, 87% are private.
87%. So the takeaway for you, our listener, is that exposure to private markets could be really critical to ensure proper exposure to the total economy.
Yeah.
It's where a lot of growth is happening outside of the public eye.
That's the key message. And interestingly, they point to a bright spot in deal making, the sports investment landscape. Yeah. In the athletic arena, sports deals have continued to grow in terms of both number and volume. They give examples like the record sale of the Boston Celtics and Peyton Manning's sports-focused production company, Omaha Productions, recently being valued at over $800 million. This ecosystem, they suggest, could offer the opportunity for less correlated return streams across both debt and equity investments. Something different.
Interesting niche. So in conclusion for deal making, the private market landscape continues to evolve, driven by aging assets and these growing evergreen funds.
That's right. And investors should probably consider maintaining a balance between traditional drawdown funds and evergreen structures as they build out their private equity portfolios, while also potentially exploring investments in secondaries and maybe even sports.
Okay, so there you have it. We've tackled JPMorgan's 2025 Mid-Year Outlook, comfortably uncomfortable, and their 5 essential questions. The core message, really, as we started, is that the uncertainty is palpable. Many investors acknowledge the likelihood of continued market flex, but they're not always sure what to do about it.
And finding clarity in this kind of volatile world really comes from defining the intent of your capital and understanding the context of your overall wealth plan. That means, your risk capacity and your risk tolerance. How much can you handle? The insights from this deep dive on these 5 essential questions are really designed to help you unlock opportunity in that uncertainty.
That's right. Our goal here was to give you maybe some comfort and confidence to stick with your long-term plan, even when things feel a little, well, uncomfortable.
Indeed, comfortably uncomfortable.
So, given all we've unpacked today, maybe the real skill isn't in avoiding discomfort altogether, but in finding your comfort within the uncomfortable.
Well said. That's the challenge and the opportunity right now.